analogy is it's just like an insurance company. There's the insurer, and then there's the insured. The insurance company is selling insurance premium. They are the ones taking on an outsized risk for something that is not necessarily likely to happen. And they do it in the right amount of size, and they do it in a diversified way that they have an edge and they have a good business model. And in fact, as the insurance buyer, you hope they do. You hope they have the capability to fulfill their obligations because you need to be protected in your specific circumstance. So maybe a trader, maybe a highly leveraged investor can own a lot of shares of certain companies that they feel strongly about fundamentally on the long side. However, earnings announcements are coming up, or there's just maybe they have a nice profits kind of run away from the mean in their favor, and they want to defend the position, but fundamentally have no reason to sell it. So they can go to the options market and buy puts. And they can put a floor on how much risk they have. And that floor is not a stop loss. The stop loss, if it touches that price, you're out. It's done. Your stock is taken away from you. The position is closed, and if it immediately spikes back up in your direction, you're out of the position. You've lost it. So your way of defining risk is a limited opportunity, because if it touches that point any time while the trade is open, you're out of the stock. But if you buy a put, you can own the right to sell it at that price, but you don't have to sell it at that price until expiration. And at expiration, you can either exercise your right, or you can roll the contract, meaning you close that month because it's expiring and you go buy a put in a different month. And that's a way to defend your position without using a stop loss. And it's very common to do that because it adds a little more flexibility. Now, all the benefits of that, the other side of the coin is that happens at a premium. You have to pay a premium value. When you study, it's called extrinsic value. It's called options premium. In that, it's just like insurance premium. You have to pay for the right to be covered. And so you pay that extra value. So if you don't use it, that premium goes away. It goes to zero at expiration. So if you buy a 1 month put, it expires a month from now, and you pay $1 per share for that put for a $150 stock, you're going to lose 0.75% on that stock value to defend that position. But if it drops 20% overnight, you're going to lock in, you're going to minimize, and you're going to reduce your exposure